The Fed has been tightening at a very aggressive pace, and I want to go a little bit deeper and dive into some of this stuff with you. So, Gavin, if you'd please pull up my slides, I think this gives you a nice summary of what the Fed's actions have been so far this year. Now, remember, the Fed funds rate was at zero for a few years, but starting March of this year, the Fed, being reactionary and waiting way too long, in my opinion, they could have gotten this inflation story under control if they were proactive. Well, they started in March. So they started with a 25 basis point hike. Then in May, they did 50 basis points. And then June, July, September, and November, a string of 475 basis point hikes in a row. And then just this most recent Fed meeting last week, they hiked 50 basis points. That means in total, they've done 4.25 percentage points in hikes of the Fed funds rate, taking it to a new range of 4.25 to 4.5%. Now, somebody asked me this question, and you might have this question too. They said, well, Dan, why is there a range? Doesn't the Fed set the Fed funds rate? The Fed does not actually set the rate. What they do is they set the range, and then they perform market activities and operations in order to get the Fed funds rate there and keep it there. So that's why there's always a range. If you actually looked at what the effective Fed funds range is, or rate is, I should say, you'll see it's in between that range. I believe right now it's currently at 4.33%, which is right in the middle of this range here between 4.25 and 4.5. So here's the question that everybody has. What is the Fed actually going to do from here? Well, we know that Powell telegraphed some of this stuff in his talk. And in my opinion, the Fed is going to hike 25 basis points at the upcoming meeting February 1st. Now, if you look at the Fed futures, this is the market that tries to handicap what the Fed's going to do. So essentially the odds or the betting on where it's going to be. And what the market's consensus is, and it doesn't mean they're always right, is that the Fed's going to get 2 more hikes in. So you have all these Fed members that are talking tough. We need to get the Fed funds rate above 5%, keep it there. I'm not so sure they're going to do that, and the market certainly does not believe them. Remember, these Fed members, they don't have a good track record. These were the same Fed members not too long ago, many of which said, you know what, inflation's not a problem. We don't need to hike. We see inflation being at 3% at the end of the year. Boy, were they wrong, and have they done a 180? I don't think that they're going to be right in this instance either, and I think market conditions are going to force their hand. But here's what I think is going to happen. I think we're going to get 25 basis points in February. Powell said the speed of the increases is not as important anymore. We can slow down. Well, what does slowing down from 50 mean? It means 25. The next Fed meeting after that is in March. Is the Fed going to do another 25 in March? They might. But if we see the unemployment rate move up and we see inflation continue to move down, they may not. We'll have to wait and see. I think they're going to be very data dependent on that one. But you can count on 25 basis points, in my opinion, in February. What's going to happen after that? Let's say they get a hike in March. They get a hike in February. What is that going to leave the Fed funds rate at? It's going to make it right around that range of 4.75% to 5%. After that, I think the Fed is going to be prudent in this, and they are going to pause. They're not going to start cutting rates after this. They're going to pause, and they're going to pause for a substantial period of time because they don't want a 1970s rerun to occur. Back then, they hiked. They thought inflation was under control. They started cutting rates. Inflation got out of control, and then they had to hike again. So they want to be sure inflation is getting corralled and under control. Here's what the Fed futures thinks. They think that after they hike 25 in February and 25 in March, they are going to pause at that level of 4.75% to 5% for 8 months. They then believe starting in November of next year, they're going to begin cutting the Fed funds rate. And they think it's going to be somewhat gradual. They think that it's going to be still elevated, but it's going to get to around 3% come the beginning of 2025. Once again, these are projections. These are what, based on the info we have right now, the market's expectation is. Of course, this can all change. Someone once asked me here recently, they said, hey, Dan, do you think that the Fed hikes are helping to really get inflation down? We have to remember, right? The reason the Fed is hiking the Fed funds rate is inflation. That's the sole reason. And it's the only tool they have to slow down the economy. They want to slow down the demand side of the economy to help inflation come down. Now, we've been getting some help on the supply side, and we'll go through some of those numbers with you. But we've seen supply chains ease up. We've seen many different economic reports out there citing easing supply chain issues. But let's just take a look at CPI. This is really, none of them are perfect, but in my opinion, this is the best inflation report that we get, better than the Fed's favorite one of PCE. And if you see here, inflation has declined. It's declined from 9.1% on that headline all-inclusive CPI to 7.1. So 9.1 to 7.1, it's dropped 2%. And if you look at the core rate, which strips out food and energy, and the Fed really focuses on, because that's what they believe they can impact with their monetary policy, that's at 6%, and that's come down from like 6.6% at the peak. So we're seeing improvements. Here's the thing you have to remember. This is why I've been critical of the Fed as well. Many people, you may have heard that the Fed has gone too far. Here's why I think that they may have, and listen, the damage is already done here. The Fed rate hikes, they take time in order to impact the economy. It doesn't work like this, where the Fed hikes and then the next day, all of a sudden, the economy is feeling the impact of that. Remember what they're doing. They are increasing the cost of certain things, whether that's car loans, credit cards, small business loans. Well, what if you're not in the market right now for a car? You're not going to feel that yet. But what if you have a lease coming due next month, 2 months, 6 months? You will then start to feel that impact, and you might think twice before getting a new car. So here's how it works. It might be 6 months. It could be even a little longer before you get the impact. So going back to this slide, we may only be feeling the impacts of these first few hikes fully right now, but we've yet to realize the cumulative and full nature of what the impact of these rate hikes will be. This is going to cause more of a slowdown in the future, and it's certainly going to cause inflation to continue to go down. However, I think inflation is going to keep going down. And let's break down why. So first of all, you could see that almost all of the different sectors here within CPI are starting to decrease. Some components, very notably, you could see gas prices, they're down 37% from the peak. Used cars, down 19% from their peak. Global shipping or freight rates, they're down 81% from the 2021 peak. Fertilizer prices, those are important. There's a high correlation to food prices with fertilizer, and we know food prices have been elevated, down 45% from the peak. Lumber is down north of like 77% from the peak, and rental and home prices, their price gains have decelerated substantially. And take a look. Every sector you see from October to November, it went down, some of them very meaningfully, with one exception, and that's shelter. And you know I've talked to you about this before, but shelter has been increasing steadily, even though in the current market, take a look at the deceleration that we've seen. Back here in the beginning of the year, if we look at home prices, according to Case-Shiller, they were up almost 21% on a year-over-year basis. That has slowed. Remember, home prices are still higher than last year, but instead of 21%, they're only up 10.6%. This should be deflationary because the pace of change, which remember, that's what inflation measures. It measures how much prices have gone up from the previous year. Well, take a look at this. This is about half of the pace of increase in home prices from where we were in the beginning of the year. You'd expect some of this to be filtered in and add deflationary pressure, but currently it's still adding inflationary pressure. How about rentals? Rentals at the peak here in the beginning of the year, they were up 18% from the previous year. That has really slowed to now only up 4.6% according to Apartment List. Now, I think the shelter component, which is, you can see, been steadily increasing, this blue line, I drew in this dotted line here, but I believe you're going to start to see this come down here in Q1 and start to add deflationary pressure, which is going to make the Fed's life easier. Because once this happens, not only are you going to see these other components coming down, but the one that is adding pressure to the upside, that is going to start to be deflationary. And I think you can start to see some meaningful declines in inflation. Those of you that are in the market for a home or looking to refinance, that means that mortgage rates are going to be lower too, because the main driver of mortgage rates is, in fact, inflation. And this example that I've used previously, I think is a great one. It's like a roller coaster. Real shelter costs, the pace has been decreasing as far as the gain. Shelter in the CPI is still going up here on the back end of the cart. When is that inflection point? I think within the first quarter. I think January, February, you could start to see that adding deflationary pressure. And look for in that quarter, inflation to really make some big declines. Something else interesting, the Fed hiking, this is slowing down the economy. And as I mentioned before, we have not yet seen the full impact of it. But, there's all kinds of signs of recession. Many people believe we're in a recession now. We may be. The goalpost has been changed, as I've covered with you before. But there's no question. Nobody can deny that the economy is slowing. There's a lot of fears out there about an earnings recession. Although we did get some pretty good earnings today from companies like Nike and such, which is part of the reason why you see the stock market propped up today. But not everybody's going to fare that well. Okay, you're going to see earnings really begin to slump. There's going to be an earnings recession. We already have a housing activity recession. Manufacturing's in a recession. There is some really steep inversions in the yield curve. And at the same time, you have a Fed that's very restrictive, and the cumulative impact is going to continue to slow down the economy. So for the first time in decades, Wall Street strategists see a down year for stocks in 2023. So it looks like here it's only showing roughly estimated here 3% decline. But what does that you think entail? Well, it probably entails, and of course this is just an estimate, but it probably entails, in my opinion, a bottoming out process in the first quarter to first half of the year, where we're going to really see the depths of the recession. Nobody knows exactly how long or how deep the recession is going to be. But remember, prices don't bottom out and then come out of the recession once it's over. It's not an exact science, but it could be halfway through the recession, right? It could be, it's never at the very tail end of it. So you don't want to wait till we're out of the recession to start investing. But this is showing me that analysts are expecting what I'm expecting. We are not seeing the lows yet in the market. We're going to see lows set in the first part of the year. Probably going to be a good time to have some fresh capital and some dry powder. And then you're going to see a potential recovery through the rest of that year, making the decline a lot less than what that original decline is going to be, but still going to probably be a down year overall in the stock market. And I think we're going to see crypto follow this path. If you think about it, the correlation has been very high between crypto and stocks. Big reason for that is the participants that are in there. Although I will tell you, there has been steadily a growing supply of price agnostic investors in cryptocurrencies that truly believe in the decentralization and the mission that Bitcoin and other cryptocurrencies are trying to solve here.